September 16, 1992. A Wednesday morning that would go down in financial history as one of the most catastrophic days for a major world economy. While most people in Britain were having their breakfast, drinking their tea, preparing for an ordinary workday, a Hungarian-American investor named George Soros was about to pull off what many consider the greatest trade in history. He was about to bet $10 billion against the British pound. And he was about to win. But here's what should terrify you. It's happening again. Right now. And this time the target isn't the British pound. It's the United States dollar. Let me take you back to that Wednesday in 1992, because understanding what happened then is the only way to grasp the magnitude of what's unfolding today. The Bank of England, one of the most powerful financial institutions on the planet, thought it was invincible. They believed they could control the value of their currency through sheer force of will and unlimited resources. They were wrong. George Soros saw something the British government refused to see. The pound was overvalued. Britain had joined something called the European exchange rate mechanism, a system designed to keep European currencies stable relative to each other. But there was a problem. To stay in this system, Britain had to keep interest rates high, even though their economy was suffering. It was like forcing a sick patient to run a marathon. The pound was trapped in a cage it couldn't escape. Soros didn't just see this weakness. He weaponized it. He borrowed billions of pounds from banks and immediately sold them, betting that the value would drop. Then other traders noticed what he was doing. Like sharks smelling blood in the water, they joined in. Suddenly everyone was selling pounds. The pressure became unbearable. The Bank of England panicked. They started buying pounds by the billions, trying to prop up the value. They raised interest rates from 10% to 12%, then to 15% in a single day. Imagine your mortgage rate suddenly jumping to 15%. The British economy would have been destroyed. They spent $29 billion trying to defend their currency. It didn't matter. By the end of that Wednesday, Britain was forced to withdraw from the exchange rate mechanism. The pound crashed. George Soros made over $1 billion in a single day. The Bank of England, with all its power and resources, was brought to its knees by one man who understood markets better than they did. They call him the man who broke the Bank of England. And for over 30 years, that trade has stood as a monument to what happens when a currency is misaligned with economic reality, when pride and policy clash with the brutal honesty of global markets. Now, fast forward to April 2, 2025. A date that President Trump called Liberation Day. Most Americans woke up that morning not knowing that their financial world was about to be turned upside down. The White House announced the most sweeping tariff policy since 1930. A 10% tariff on virtually every country in the world. Higher tariffs on specific countries with large trade deficits with America. It was economic warfare on a scale not seen in almost a century. The reaction was immediate and devastating. But here's what nobody expected. Here's what broke every rule in the financial playbook. The dollar didn't rise. It collapsed. Let me explain why this is so strange, so unprecedented, so terrifying. For decades, the US dollar has been what investors call a safe haven currency. When trouble hits the world economy, money flows into dollars. When wars break out, money flows into dollars. When markets crash, money flows into dollars. The dollar goes up when things go bad. That's been the iron law of global finance for 70 years. April 2025 shattered that law. When Trump announced those tariffs, when the biggest trade war in modern history erupted, the dollar didn't soar to safety. It sank. Against the euro. Against the yen. Against the Swiss franc. The currency that was supposed to be the ultimate refuge became something investors were fleeing from. The stock market imploded. The Dow Jones fell 1,600 points in a single day. But that's not the shocking part. Markets crash all the time. What shocked the financial world was that the dollar fell too. In past crises, when American stocks fell, the dollar rose as investors sought safety. This time both fell together. It was like watching the laws of gravity reverse. On April 3rd, the dollar dropped by 1.3%, its biggest decline since 2023. It hit 6-month lows against the euro. Investors weren't just selling American stocks. They were selling America itself. The message was clear and brutal. The world's confidence in the United States, in its economic policy, in its currency, was cracking. And here's where it gets truly frightening. Hedge funds, the sophisticated investors who move billions with a single trade, saw this weakness. And they did exactly what George Soros did in 1992. They started betting against the dollar. Massively. The data is staggering. Speculative positions against the dollar have reached levels not seen in 20 years. Hedge funds are in what analysts call extreme short territory. They're borrowing dollars and selling them, betting the value will fall just like Soros did with the pound. The positioning index shows one of the most lopsided bets in modern financial history. Everyone is on one side of the trade. Everyone is betting against America's currency. Think about what that means. Some of the smartest, most well-informed financial minds on the planet, people who have access to information and analysis that you and I will never see, are betting billions that the dollar is going to fall. They're not hoping it falls. They're making it fall through the sheer weight of their trades. Before April, investors were massively long on the dollar. They were betting it would rise. They held some of the largest bullish positions in years. Then Liberation Day hit. Those positions flipped from net long to net short in a matter of weeks. It was one of the fastest reversals in currency trading history. European hedge funds started ramping up option trades betting the euro would strengthen against the dollar. Asian funds did the same. In October, bearish option trades on the euro versus the dollar saw 3 times more volume than bullish ones. 3 to 1. That's not a bet. That's a stampede. And the parallels to 1992 are haunting. Just like Britain was trapped in the exchange rate mechanism with an overvalued pound, the United States finds itself trapped by decades of policy that have stretched the dollar beyond its natural value. Just like the Bank of England refused to see reality until it was too late, questions are now being asked whether American policymakers understand what's happening. But there's a crucial difference. When Soros broke the Bank of England, it was one country, one currency, one economy. The global system survived. If the dollar breaks, if faith in America's currency truly collapses, we're talking about something else entirely. We're talking about the end of the financial world as we know it. The dollar isn't just another currency. It represents roughly 58% of all global reserves. When central banks around the world need to hold foreign currency as a safety net, they hold dollars. When international trade happens, it's priced in dollars. When you buy oil from Saudi Arabia, you pay in dollars even if you're in Japan. The entire architecture of global commerce is built on dollar dominance. That dominance is now being questioned. Loudly. Publicly. By people who matter. Billionaire fund managers are making bearish calls on the dollar that would have been considered financial heresy just 2 years ago. Analysts are openly discussing what might replace the dollar as the world's reserve currency. These aren't fringe theories anymore. These are mainstream conversations happening in the boardrooms of major financial institutions. The European Central Bank published research in November 2025 analyzing what happened in April. Their findings should disturb anyone who holds dollars, which means it should disturb anyone who lives in or trades with America. They found that speculative positions on the dollar remain mildly negative despite earlier depreciation, suggesting traders don't expect a rebound. The correlation between U.S. Treasury bonds and the dollar, which used to move in lockstep, has weakened dramatically. Translation? The old rules are dead. The relationships that govern global finance for generations have broken down. Markets are behaving in ways that the historical models can't explain or predict. And when markets enter uncharted territory, when the old maps no longer work, that's when catastrophic losses happen. That's when fortunes are made and destroyed. Treasury markets are now pricing in future rate cuts from the Federal Reserve. Economic growth is decelerating. Dollar funding markets are tightening. Every indicator that historically supported dollar strength is flashing warning signs. Yet the response from policymakers appears slow, uncertain, trapped in outdated thinking. Analysts at major firms are warning that when a trade becomes this crowded, when everyone is positioned the same way, the market becomes fragile, vulnerable to sudden reversals. But here's the thing. Sometimes crowded trades are crowded because they're right. Sometimes everyone is selling because there's a real reason to sell. The trick is knowing which situation you're in. Let's talk about what drove this crisis. The tariffs were the trigger, but they weren't the cause. They were the moment when accumulated pressures found their release. For years, the dollar had been elevated by factors that couldn't last forever. Interest rate differentials that made holding dollars attractive. A perception of American economic exceptionalism that ignored mounting problems. Political stability that could no longer be taken for granted. When Trump announced those tariffs, he didn't just start a trade war. He shattered a narrative. The narrative that America was the safe, stable, predictable center of the global economy. Suddenly, the United States was the source of chaos. The origin of uncertainty. Capital doesn't like uncertainty. Capital flees uncertainty. And capital fled. Foreign investors, especially in Asia, started hedging their dollar exposures at a scale never seen before. If you're a Japanese pension fund holding billions in American stocks and bonds, and you suddenly see the dollar falling while those assets are also falling, you're losing money twice. Once on the asset value, once on the currency. That's when you hedge. That's when you protect yourself by betting against the dollar. That's when you become part of the problem you're trying to avoid. The dollar fell 12% against the euro from the start of 2025, with 7 percentage points of that decline coming after April 1st. 12% might not sound like much if you're thinking about the price of a coffee. But for a major reserve currency, 12% in less than a year is an earthquake. It's the kind of move that destroys companies, topples governments, and rewrites the global economic order. And it's not stopping. As of late November 2025, traders are expected to stay net short on the dollar through the end of the year and beyond. The positioning hasn't reversed. The hedge funds haven't backed down. If anything, the conviction is growing stronger. Some analysts argue this is similar to what happened to the British pound in 1992, but in slow motion. Instead of one catastrophic Wednesday, we're watching a months-long deterioration. The outcome might be the same, just spread across a longer time frame. Death by 1,000 cuts instead of one dramatic blow. Others warn that the comparison isn't quite right because the dollar is so much larger, so much more important than the pound ever was. They say the dollar can't truly collapse because there's no alternative. The euro isn't stable enough. The yen is from an economy with its own massive problems. The Chinese yuan is controlled by a government that won't let it freely float. Gold can't facilitate modern digital commerce. Cryptocurrency is too volatile, too new, too unproven. But here's what those people miss. The dollar doesn't have to disappear for the world to change dramatically. It just has to weaken enough that its dominance erodes. It just has to lose enough trust that countries start diversifying their reserves more aggressively. It just has to become unreliable enough that international trade starts finding alternative arrangements. And that process has already begun. Central banks have been quietly reducing their dollar holdings for years. China and Russia have been working on bilateral trade agreements that bypass the dollar. Europe has been discussing strategic autonomy that includes financial independence from American systems. These efforts were slow and uncertain. Until April 2025. Until the moment America itself became the source of global instability. Now those efforts have urgency. Now they have political support. Now they have the most powerful argument possible. The argument that holding all your eggs in the dollar basket is dangerous. That depending on America for financial stability is a risk that must be managed. The implications are staggering. If you're an American, a weaker dollar means imports become more expensive. That television from Korea costs more. That German car costs more. That vacation to Europe costs more. Inflation rises not because your economy is overheating, but because your currency is weakening. It's insidious. It's hard to stop. It feeds on itself. If you're an investor, a weaker dollar changes everything. American stocks might rise in nominal terms but lose value in real international purchasing power. Bonds become less attractive. Real assets, commodities, gold become more important. The entire calculus of portfolio management shifts. If you're a country holding dollar reserves, you're watching your wealth evaporate. You're asking hard questions about why you're financing American deficits. You're wondering if there's a better way. And when enough countries start asking those questions, when the momentum shifts, it becomes self-fulfilling. The dollar weakens because people expect it to weaken, which causes it to weaken more, which reinforces the expectation. This is the trap George Soros understood in 1992. This is the dynamic that broke the Bank of England. When market psychology turns against a currency, when the narrative shifts, the resources of even the most powerful institutions become inadequate. You can't stop a river by standing in front of it. You can't hold back the ocean with your hands. And you can't support a currency when everyone in the world is selling. The question isn't whether the dollar can be defended. Of course it can. The Federal Reserve has tools. The Treasury has resources. The U.S. government has power. The question is whether those tools will be used, whether there's political will to use them, and whether they'll be used in time. Because here's the final, crucial parallel to 1992. The Bank of England waited too long. They convinced themselves the pressure would ease. They believed their reputation and power would be enough. They tried half measures when full measures were needed. By the time they were ready to do whatever it took, it was too late. The market had already decided. The outcome was already determined. Is America making the same mistake? Are policymakers watching the dollar weaken and telling themselves it's temporary, it's manageable, it will reverse on its own? Are they underestimating the determination of the traders betting against them? Are they trapped by political considerations that prevent them from doing what markets demand? We don't know the answers yet. But we know the questions are being asked. We know the bets are being placed. We know that billions of dollars are flowing based on the belief that the dollar's decline is real, is justified, and will continue. Some of the most sophisticated investors in the world are positioned for this. They're not hoping for it. They're expecting it. They've done the analysis. They've run the models. They've looked at the debt levels, the political dysfunction, the trade policies, the loss of faith in American institutions. And they've decided the dollar is going to fall. Maybe they're wrong. Maybe this is like past episodes where dollar bears got crushed when the currency suddenly rebounded. Maybe American economic resilience will once again prove the skeptics foolish. Maybe a policy shift will restore confidence and capital will flood back into dollars. But what if they're right? What if we're living through the early stages of a historic currency crisis? What if April 2025 will be remembered the way we remember September 1992? Not as a temporary disruption, but as the day everything changed. The day the dollar's dominance began its terminal decline. George Soros saw a crack in 1992 and turned it into a chasm. He bet everything that the Bank of England couldn't hold. And he won. The question now is whether today's billionaire fund managers see a similar crack in the dollar. Whether they're betting everything that America can't hold. And whether they'll win too. The numbers suggest they might. $10 billion in short positions against the dollar. Extreme positioning not seen in 2 decades. 3-to-1 ratios in bearish options. Central bank analysis questioning the dollar's safe haven status. All of it points in one direction. History doesn't repeat, but it rhymes. The circumstances are different. The scale is larger. The consequences are more profound. But the underlying dynamic is hauntingly familiar. An overextended currency. A policy trap. A government that may not act in time. And sophisticated investors betting billions that gravity will eventually win. You might be wondering what this means for you. Whether you should be worried. Whether you should be doing something. The honest answer is that nobody knows for certain. Markets are complex. Predictions are hard. The future is uncertain. But ignoring the warning signs because the outcome is uncertain would be foolish. What we know is this. The dollar weakened dramatically in April 2025. It hasn't recovered. Professional traders are betting it will weaken more. The structural supports that held it up are eroding. The political environment is creating instability rather than confidence. And history shows that currency crises can unfold faster than anyone expects once confidence breaks. What we also know is that George Soros made $1 billion in a day by seeing what others refused to see. By acting when others hesitated. By understanding that sometimes the institutions we think are unshakable are actually fragile. That power and resources aren't enough when you're fighting market reality. The billionaires betting against the dollar today learned from Soros. They studied 1992. They understand the playbook. They know that central banks can be broken. They know that currencies can fall. They know that consensus can be wrong. And they're putting their money where their analysis leads them. Are they the villains? Are they causing the problem or just recognizing it? That's a philosophical question without a clear answer. Markets are amoral. They don't care about nations or politics or loyalty. They care about value. And if the dollar is overvalued relative to economic reality, if policy has stretched it beyond what fundamentals support, then traders betting against it are simply doing what markets do. They're correcting an imbalance. The tragedy is that these corrections are rarely gentle. They're usually violent, sudden, devastating to ordinary people who did nothing wrong except be born in a country whose currency is collapsing. The British people who lost their jobs when interest rates spiked to 15% didn't create the exchange rate mechanism. They just suffered from it. If the dollar crisis deepens, if the bets against it prove correct, millions of Americans will feel consequences they didn't cause and don't understand. Their savings will lose purchasing power. Their cost of living will rise. Their economic security will diminish. Not because they made bad choices, but because their country's currency became a battlefield. That's the cruel mathematics of currency crises. The pain is widely distributed. The profits are narrowly concentrated. George Soros made $1 billion. Britain lost billions. Hedge funds betting against the dollar might make fortunes. Americans might lose purchasing power on every dollar they own. Which brings us to the fundamental question. The question that should be keeping policymakers awake at night. The question that will define the next chapter of American economic history. Can the dollar be saved? And more importantly, will it be? The technical answer is yes. The Federal Reserve could raise interest rates dramatically, making dollars more attractive. The government could reverse trade policies that create uncertainty. Political leaders could restore confidence through competent, stable governance. International agreements could be reached to stabilize currency markets. The tools exist. But tools are useless without the will to use them. And using them would require painful choices. Higher interest rates would slow the economy, possibly cause a recession. Trade policy reversals would require political courage. Stable governance would require setting aside partisan warfare. International agreements would require compromise and cooperation. Are American institutions capable of those choices? Is the political system functional enough to respond to a slow-moving crisis before it becomes acute? Can leaders put long-term stability ahead of short-term advantage? These aren't economic questions. They're political and social questions. And the answers will determine whether the dollar survives its current crisis. The next few months will be critical. If the dollar stabilizes, if short positions get squeezed, if confidence returns, then the crisis will be remembered as a scare. A warning. A moment when things could have gone wrong but didn't. Markets will move on. The dollar will remain dominant. American exceptionalism will claim another victory. But if the decline continues, if the short positions prove correct, if more capital flees dollar assets, then we're in uncharted territory. Then the comparisons to 1992 become inadequate because what's happening is bigger than a single currency crisis. It's a shift in the global economic order. It's the beginning of the end of dollar hegemony. It's a transformation that will reshape how the world economy functions. George Soros didn't break the Bank of England to make a point. He did it to make money. But the money was just the proof that he was right. The proof that he understood something important that others missed. That pride and power aren't enough when fundamentals are broken. That markets are more powerful than institutions when they decide to be. The billionaires betting against the dollar aren't doing it to hurt America. They're doing it because they think they're right. Because their analysis tells them the dollar is vulnerable. Because the data supports their position. Because, like Soros, they see a crack and they're going to exploit it. Whether they'll be proven right is the $10 billion question. The answer will shape your financial future whether you're paying attention or not. Whether you understand currency markets or not. Whether you think this matters or not. Because when currencies move, everything moves. Prices, savings, jobs, power, the world itself. September 16, 1992 changed Britain forever. The country eventually recovered, even prospered, but it was never the same. The myth of the Bank of England's invincibility died that day. The British pound never regained its former status. The trajectory of the nation shifted in ways both obvious and subtle. Will we look back on April 2025 the same way? Will that be the date when American financial dominance began its irreversible decline? When the dollar started its long journey from world reserve currency to just another currency? When the United States learned the hard lesson that Britain learned in 1992, that no country, no matter how powerful, is immune to market forces when fundamentals turn against it? Only time will answer these questions. But the bets are being placed now. The positions are being taken now. The future is being shaped now by decisions made in trading rooms and central banks and political offices around the world. And somewhere, maybe in New York or London or Hong Kong, someone is looking at the charts, analyzing the data, sensing the opportunity, and thinking about George Soros in 1992. Thinking about what happened when one man bet against a currency everyone thought was invincible. Thinking about the billions that could be made by being right when everyone else is wrong. And placing their bet against the dollar. Right now.